$110,000 in backtested P&L across 3 instruments and 0 breaches across 6.25 years. This is the Old Bainbridge Capital Core portfolio, a fully automated system built from scratch, and today I'm breaking down exactly how it works, where it fails, and what we learned from it. Trading futures involves substantial risk of loss and is not appropriate for all investors. So Old Bainbridge Core is a systematic multi-asset futures trading portfolio. It covers 12 different strategies across 3 instruments, 2 asset classes, and is entirely automated. The data is backtested 6.25 years or 6.25, so from January 1st all the way until March 31st, 2026. And the portfolio was structured around prop firm deployment, more specifically the Tradeify 150K Lightning account. We decided to target prop firm deployment due to its limited risk and how approachable it is to the average retail trader. So since January 1st of 2020, the net profit was $110,000 with a max drawdown of $3,767 and a return to drawdown ratio of 29.3 with a Sharpe of 2.57. So what is OBC Core? It includes 12 intraday strategies, each with their own entry and exit rules, 3 futures instruments, MNQ, MES, or MCL. This covers 2 separate asset classes, which is the energy sector, being crude oil, MCL, and NASDAQ and S&P 500, which are equities. The data is backtested on 6.25 years. It includes the COVID crash, rate hikes, volume compression, and its eventual recovery. Our monthly win rate was about 77%, with 58 out of 75 months being positive across the backtest. The execution is completely automated 100%. It is deployed on NinjaTrader 8. This strategy also passed all 3 of our stress tests, including walk-forward analysis, permutation, and Monte Carlo testing. So within the 3 instruments, there are 4 strategies within the micro NASDAQ portfolio. In the backtest, it performed 2,417 trades, carrying around 40% of the P&L. MES, or the micro S&P 500, had 5 strategies with 1,300 trades, carrying 43% of the P&L. And within micro crude oil, there were 3 strategies, totaling 508 trades and making up 18% of our P&L. In NASDAQ, we targeted equity momentum and breakout. In the S&P 500, we targeted mean reversion. And for crude oil, it was a good energy sector diversifier. Our MNQ strategies perform best in trending equity days, high volume sessions, and strong opens. It struggles in extended chop, range-bound equity. Its portfolio role is the primary return engine, and it complements MES and MCL very well. MES is best in structured markets with overnight gaps and extremes. It struggles in extreme low volatility, and its portfolio role is the stabilizer. Crude oil is best in volatile markets, trending energy, and supply shocks. It struggles in extended crude consolidation and is more dependent upon large winners. Its portfolio role is being a non-equity instrument. It has different fundamentals and hedges NASDAQ and S&P 500 performance. As you can see, the struggles of all 3 relate. It has to do with low volatility and consolidation. Later in the video, we'll do more of a regime-dependent analysis on the portfolio as a whole. So our investment thesis, there was 3 structural patterns we really looked for, which were opening range momentum, afternoon trend continuation, and mean reversion. So upfront, the portfolio has an edge because it requires simultaneous execution across 12 different strategies on 3 separate instruments. That gives an automation barrier, and the micro market size creates natural protection. This portfolio is well diversified with a correlation score of 0.03, and the strategies within the portfolio hedge each other properly. There's no single regime that eliminates all 3. In 2023, when MNQ collapsed, MES and MCL carried the portfolio. Since 2019, micros have matured with tighter spreads, and funded programs like prop firms enable scalable deployment. So our performance, we have a 77% monthly win rate, with 58 out of 75 months being winners. We used around 72% of our drawdown utilization, given the prop firm account that we're basing this around of $5,250 of drawdown, and every single year was profitable. Our monthly average return is $1,474, with once again the return on drawdown being 29.3. Our worst month was $2,000 with a max recovery of 89 days. Our risk-adjusted metrics are the Sharpe ratio of 2.57, Sortino of 5.14, and a profit factor of 1.37. In previous videos, I've said that a profit factor of 1.5 and above is really what we're going to look for. However, I'm going to be more lenient on this one because this is a portfolio of multiple strategies. Many of the strategies within the portfolio have a profit factor of 1.5 and above. Their different drawdown periods and performances are combating each other and therefore lower the average trade and profit factor as a whole. So here's a zoomed in version of our portfolio equity curve. In orange, or the bottom equity curve, we have MCL. The blue equity curve, or the middle one, is MNQ, and then the green is MES, with the yellow curve being our combined performance. On the bottom, we have a visual of our drawdown, with the orange dotted line being 80% of our drawdown and the red dotted line being our drawdown limit. You can see our worst performances were in the beginning of 2022, beginning of 2024, and around the middle of 2025. So our performance across time, a year-by-year analysis. Our average monthly P&L is $1,474, with our best month being $7.7 thousand and worst month being $2,000. All 7 years are profitable so far. However, we have to wait for 2026 to play out to really claim that all 7 years will be, but for now we know all 6 are. 2022 was our best performer. However, the results aren't drastically different from other years, and we see an overall consistent picture of our P&L per year. For correlation and diversification, MNQ and MES, as well as MNQ and MCL, have a near zero correlation, and our best correlation was actually MES and MCL with a negative correlation of 0.048, a natural hedge. So taking the drawdowns of all 3 separate instrument portfolios, it totaled 9,295. However, when we combine them in the same portfolio, allowing them to trade on the same days, same weeks, and same months, the combined drawdown was only 3,700, which is about a 60% drawdown reduction. Correlation is important because uncorrelated drawdowns don't compound, they offset one another. So one of my favorite slides is the regime and market context. We saw that the VIX, or the volatility of the market, heavily affect our portfolio. When volume is trending, the VIX is high. When we're seeing rate shocks and supply events, our average daily P&L was $149 with a Sharpe of 3.67. In average to medium ranges with steady trends, we have an average P&L of $54 per day and a Sharpe of 2.38. And when we're seeing directionless chop, fear-driven gaps, and a lower VIX or volume, we saw only $14 per day with a 0.9 Sharpe. Here you can see the performance by market period, showing the results of COVID, second half of 2023 when bond yields were up, as well as the performance in the most recent quarter. Instrument rotation is really important. So this shows that leadership rotates across instruments 70% of the months, and only 1.3% of months had all 3 instruments negative. 43% of the time MES was leading, 35% of the time MNQ was leading, and 23% of the time MCL was leading. These are really great statistics to see. It shows that one specific instrument does not carry the portfolio, and it implies that when 1 or 2 of the instruments are performing poorly, the other one will pick up the slack. So here's a quick snapshot of our stress testing. Our walk forward had a 10 out of 10 add a sample window with a mean profit factor of 1.39, a 0% probability of negative P&L across the 6.25 years, and a median profit of 108,000. And in our permutation test, we saw statistical significance with trade outcomes randomly shuffled 5,000 times. There were 0 other permutations that matched our P&L, Sharpe, and profit factor. Something I wanted to note as well is in our Monte Carlo analysis, we actually saw the median drawdown was around 5,250, which is exactly what our drawdown limit is in the prop firm. Now, at first, I was kind of taken aback. I was concerned about that statistic. However, the simulation process of Monte Carlo kind of tears apart the intentional correlation that we were creating between the different instruments, and therefore increased the mean drawdown by about $1,800. The Monte Carlo mean drawdown is still something to pay attention to. And in live performance, if we were to see drawdown increasing at an unexpected rate, we would manage our positions accordingly. So a very interesting portion is the funded account deployment. So we took an example of the Tradeify 150K Lightning account. If you're not aware, proprietary trading firms allow you to buy accounts with more capital than you originally have. So for example, in this case scenario, the cost is $478 to buy $150,000 in leverage with a drawdown of $5,250. To put it plainly, you can give a prop firm $500 for access to $5,250 in trading capital. You might be thinking that's a really good deal and doesn't really make a lot of sense. But proprietary trading firms account for this by enforcing payout rules, consistency rules, intraday rules, meaning you can't hold trades overnight, etc. And like I said before, this automated portfolio was crafted around those rules. Given that every strategy is intraday, it closes at 3:55 p.m. Eastern Time. Its backtested drawdown is above the $5,250 drawdown limit. So given the specific consistency and payout rules on this given account, this is what our payout structure would look like. Our mean takeout for the first payout with a goal of $9,000 would take about 6 months, and the take home would be $9.3 thousand. The second payout with a goal of $4.5 thousand in comparison to 9 would take around 4 months with a mean take home of around 6,000, and so on and so forth. If you're mildly confused on the funded account deployment, prop firm rules overall, I'll be making a video with a more detailed analysis on this part of the portfolio, as well as how to approach proprietary trading firms properly. The Old Bainbridge Core portfolio generated $110,000 in profit with a max drawdown of $3,767. It had 0 breaches of the $5,250 funded account limit. The 3 uncorrelated instruments reduced the drawdown by 60%, with equity indices and crude oil, and they rotate leadership every single year. It was statistically validated with our permutation testing. It was profitable in 10 out of 10 walk forward steps, and our Monte Carlo probability of a negative outcome was 0. And it was designed for funded account deployment. With this specific case study, you take a $500 account, first payout in around 6 months would be $9,000 to $10,000, 3 years netting $37,000, and self-funding at 3+ accounts. So the known risks that I'm going to be looking at in the future are volatility compression. We saw the worst periods of performance were low VIX, low volume, and a consolidating market. Past results are not indicative of future performance. And even though the instrument-based strategies were uncorrelated in the past, does not mean that for brief periods of time in the future, they cannot become correlated. Another risk is execution degradation, meaning if the brokerage we use consistently has poor order fills and we're seeing a lot more slippage per trade, that can decrease our profit and increase our drawdown. And last but not least, due to the structure of proprietary trading firms, there is early account vulnerability. In the first 3 months, we're walking directly on the drawdown line without a cushion of capital in between us and the drawdown, and therefore the likelihood of breaching that drawdown is higher in those first 3 months. With that being said, going forward, we have actually deployed this on the funded account. I'll be updating the channel with live performance results, whether they're good or bad, what went wrong, what went right, hopefully, as well as future videos of how I built something like this and my thought process going towards it. If you're interested at all in getting your own strategy optimized, backtested, or stress tested, visit our website. And if you want to learn how to build a portfolio like this, being able to run it on personal capital or through a proprietary trading firm, click Learn, put in your first and last name as well as your email. You'll gain updates on our growing research library, how we backtest, and how we apply institutional level analysis to our own trading strategies. This is all early access and still development, so we'll ask for a little bit of patience, but I promise you that it will be worth it once that library is out and available. This is just the first version of our fully automated multi-strategy portfolio. Every day I'm going to be looking for more strategies that can increase the profit and reduce the drawdown across more than just these 3 instruments. I hope you were able to learn something from this video and gain some inspiration to look into systematic and automated trading and possibly build something like this on your own. Thank you for watching.